Hey, everybody, this is Charles Dobbins. Welcome to this week's edition of the Multifamily Investing Academy podcast. I have an old friend who I've interviewed before, Mr. Tim Milazzo from StackSource. Welcome, Tim.
Charles, it's a pleasure.
Thank you. Of course it is. I got to tell you, you're wise beyond your years, because for those of you that are old-time fans of the show, when I first interviewed Tim, he was living up in New Jersey, and he just informed me that he's having a beautiful day down in sunny Florida because he got while the getting was good, and he was still young to enjoy it. He was wise beyond his years. So good for you, Tim. Packed up the whole family and moved down there. Where'd you go?
We're in New Smyrna Beach, Florida, which is on the East Coast. So we're about an hour from Orlando and 20 minutes from Daytona Beach. We live about 10 minutes from the beach. Our kids love the beach. My wife loves the beach. It's a good place for them to grow up. And I'm continuing a proud New Jersey tradition of retiring down to Florida, but I've still got a lot of work left in me. And so I'm just working down from Florida.
Yeah, good for you. I mean, up here in New Hampshire, we're kind of not, there's that crowd that goes to Florida, but we're getting more of the crowd that goes to the Carolinas now.
Yeah.
That's it. They call them half.
You call them snowbirds if you disappear for the winter down south and then come back.
Yeah, but there's something called they're snowbirds, but there's something where they only go halfway down. There's a term for those people that only go halfway down. Yeah.
I'm unfamiliar with that then.
Yeah, I'm not. I'm kind of, all of my buddies from the club I belong to, they all go down to Florida. So I think ultimately I'm going to be heading down to Florida. That'll be my shtick. So
the more the merrier.
Yes. Now, I always love the concept of StackSource because, you're building the capital stack, and where are you going to source that stack? And hence the name StackSource. So you were coming at this from a debt and an equity side in order to come up with solutions for the entire debt side. Now, when I started with you, talking with you, you were down. I mean, the market was kind of starting to turn for the benefit. And if folks, you got to check out Tim's, and Tim, it's been a while, but tell me, the platform that you use has, it's really kind of cool. You put the information in and it spits out all the different options that you can have with your deal. So bring me up to speed on where you guys are now with your platform.
Right. Yeah. And so we had launched a few years ago as a capital marketplace because there really hadn't been something in commercial real estate finance that you can get. Here are my matched lenders, and here are ratings from other borrowers, and how fast can they close, and what terms can they offer. And that was the first thing we built at StackSource, was a prototype of just the tech side of what lenders do I match with, and how do I view what my matched capital sources were. The next thing, as we kind of tested, okay, what pieces of the process can we automate? And what pieces of the process, is it always going to be a conversation? Is it going to be a negotiation? We started building into a full service capital advisory team. And so we built a team of capital advisors across the country, ex-bankers, ex-brokers, people very well-educated and willing and ready to help borrowers that are discovering their matched lenders on our platform. And 2-3 years ago, it was, hey, I have a term sheet from my local bank at 3.3%. What's the best you can do? Oh, you're missing that credit union that will give you that same leverage at 2.9%. And that was a use case for StackSource a couple of years ago. As the market has shifted, as interest rates have risen dramatically, starting in the beginning of 2022, we started introducing, hey, here are other alternative capital providers on the platform. And I'm not just talking private lenders, though that is certainly a segment of capital providers on our platform, but what other sources can come into the capital stack above and beyond the senior loan to make that deal pencil, and make it so that the equity I have and that 65% loan quote that I just got at 6.5%, what fills the capital stack in between? And that has been the theme for us in the last year and a half, call it. And that's been our biggest area of growth.
Really? Okay. So tell me how that works. and let's use a real life example that I'm probably going to be putting into your system in the next day or so. Hotel conversion, purchasing a hotel. About a $6 million deal. We plug in all the information, we get this over to you, and you then come back. It's in the Bible Belt sort. Let's just say it's in the Bible Belt. I'm not going to give out many details right now, but let's just say it's in the Bible Belt area. What are you going to come back with for me on that type of property?
Right. Yeah. So in the past, if you would have seen matched lenders or talked to our capital advisors about what lenders you might be interested in that type of conversion, in that zip code, and with this capital, basically you will still get those matched lenders, and you can filter only show me non-recourse or only show me who can go up to this leverage. We've extended that into other categories, including one being subordinate debt. So if you've heard of mezz debt, that is subordinate to the senior loan. It is not technically usually like a second lien on the property. It's usually a loan against equity, right? And so that would be mezz debt, or we'd consider that whole category to be subordinate debt. And then the same concept, filtering to, hey, who can go up to a combined LTV of this, or who has a rate at closer to 12% versus closer to 16%, because these mezz lenders are much more expensive. In addition to subordinate debt, we now also have equity partner matching. So StackSource is a platform. We are not a crowdfunding portal with 10,000, LP investors looking to invest a few $100s or a few thousand. Instead, it's here are potential equity partners that are themselves private equity real estate funds, or perhaps a family office that might be interested in a certain type of deal. They're one check. They're one source of capital that could come in at a preferred equity or equity partnership level. And now those are typically starting at 3 to 5 million as far as a check size. We do have some smaller equity providers in that 1 to 3 million space for experienced sponsors that know what they're doing. For any type of real estate sponsor with a quality deal and a quality balance sheet, we can still do senior debt placement. And for those more seasoned sponsors that have shown, hey, we know how to execute on this business plan, and we've done it on past deals, and we have a network of our own investors that we've returned capital to, hey, you may be ready for your first institutional or sub-institutional equity partner that you can be matched to, or a subordinate debt fund. And so these are the types of capital providers that we've added to StackSource and made available for matching, show like ratings of other borrowers that have worked with them, and rank and even allow borrowers to filter to these types of capital providers on our system.
Interesting. So let me ask you, how has the last year been for you? What changes? Not so much, from a competitive standpoint, but like what have you had to do differently in order to be competitive and to solve people's problems?
We probably wouldn't even be here at this point today had we not shifted into providing multiple sources of capital in the stack. So everything that we did 2 years ago was pretty high leverage and like pretty easy money. And we were in the easy money era, shifting towards this, what I'll kind of call thematically is structured capital. So you have multiple layers of capital in the stack. That has been the biggest growth in our business. And so our capital advisors are really good at underwriting, structuring, and negotiating, because when we approach an equity partner, even where they're matched, hey, yes, they do like this type of multifamily conversion, they do like that county that you're in, even if they're matched, they need to be convinced to work on that deal and convinced that this is a deal worth partnering from an equity level. And so we have, in addition to adding these types of capital providers, our capital advisory team. So these are the StackSource professionals that talk with you about the deal and work with you on the equity placement. They're doing a full service of pitching the deal to those equity capital sources and to those subordinate debt capital sources in a way that it's, adding credibility to the deal, and it is setting the right expectations on both sides of this capital marketplace in a way that's really not necessary when we're just showing a bank or a credit union a senior debt deal. but equity is much more of a relationship game. And so we've had to develop that high touch model of pitching these equity deals to these potential equity partners, even if we've brought transparency through the platform to who and what types of equity partners are available.
Okay, now walk me through the process. I go online, I fill in all the blanks, I get you the information that you need, I hit the enter button. How do I interact with a capital advisor? What is that relationship like?
Yeah, so we're first reviewing. So first of all, a capital advisor that works for StackSource is assigned. And so these are longtime real estate professionals that, again, have been brokers and bankers, and they're super credible, and they've worked on collectively billions and billions of dollars of real estate financings. As a matter of fact, at a platform level for StackSource, we've closed a couple $1 billion of real estate financings at this point. And so we look at the underwriting, and we need to make sure that underwriting makes sense. So there's a vetting process that happens right up front. You have a conversation with your capital advisor to fill in any blanks, to answer questions about the deal. Hey, talk to us about this construction budget to go from hospitality to multifamily. We need to fill in any blanks in our understanding so that package that goes out to these capital sources is clean and compelling to a point where the first look is making them want to engage and get you to the top of the stack on all of their investment opportunities. Because there are a lot of investment opportunities out there today, and not a lot of them pencil out and become compelling opportunities for these real estate equity funds. And so we need to get you to the top of the list and the top of the stack on that first look. So there's a preparation process with your capital advisor where you answer the questions, where we talk about the underwriting, where we ask, hey, where did you get comps for that multifamily conversion? Let's look at some of these comps together and get a really clean package. If you have a clean package, you get a good first look, and a good first look is really important, especially when you have an equity raise opportunity.
Interesting. Okay. Now, what types of changes have your underwriters gone through with some of their pro forma, recommendations? For instance, how are they looking at rent increases? What type of exit cap rates are they now looking at? What are they expecting for expenses? I already said expenses, but the rents. I didn't say expenses, but like what type of increase in expenses are you guys now underwriting for?
The shelf life on a comp has shortened dramatically. We can't together collectively, because we're on the borrower's side saying, here are your options in the capital markets, and we're going to ensure the best outcome, and we're going to help you negotiate the best financing structure. We can't use comps. We can't use value or rent comps that are a few quarters old or even a few months old. You can't use an appraisal on, in the same neighborhood from 9 months ago, because commercial and multifamily property values nationwide, and there are exceptions here for submarkets, but nationwide, they're falling. And so if you have, especially if you have a touchy asset class, and actually multifamily at the moment, from a value perspective, is considered a touchy asset class because it's way up from 4 or 5 years ago, but it's not way up from 12 months ago. And so there can be a debate on what a multifamily in a given market. You can still be in a hot market. If you're in a cold market and you're using a multifamily comp or appraisal from 9 months ago, you're not on the top of the stack. You're getting thrown in the rejection pile.
Yeah.
You need to understand what the drivers of value are today. And it's just treasury yields are very different today than they were. And you have to think, if you're talking about attracting institutional capital, if you want to work with that type of equity partner, their LPs are looking at real estate with a risk premium to just buying a treasury bond. And if treasury bonds are up 100 basis points, you better believe they don't believe the cap rate is the same as it was 9 or 12 months ago.
Exactly.
It's just not a credible argument to an equity fund today. And so we can't use that. That is like recency of comps and understanding that there's going to be cap rate pressure. Again, you can have a hot market, a cold market, but this is a conversation about a value, even in multifamily today, not even touching asset classes like office, which is in a free fall.
Interesting. Wow. And what about different areas? What are you seeing in different areas of the country? Let's talk about Arizona, Phoenix. I mean, that was the hottest place in the world. What's happened to it in the last 6 months? Same with Dallas, even South Florida. What's going on?
Multifamily has amazing tailwinds if we're talking about still the next decade to come. And you know what? Housing affordability is a huge problem in this country. And so that is going to continue to fuel the demand for multifamily. But there are pockets, and even talking about Phoenix or Dallas, you then have to drill in at a submarket level and say, well, how much multifamily is going to be delivered here in the next 18 months, and how, what employers are coming to the area. It's really become a sub-market conversation. You can't just say this is Phoenix, this is Dallas. There's just excess demand everywhere. We're actually drilling in at a sub-market level here, and we're saying, okay, well, what neighborhood in Phoenix, or what are we talking? Are we talking Scottsdale? Are we talking Phoenix proper? We're going to start to drill in and get much more specific about where are the comps, what's going on there, how much delivery is happening in your sub-market. Do we have new employers? That's the way real estate was traditionally done, before this last 5 years of hot markets. And it's what you have to learn to do again at a fundamental level. If you're a multifamily investor, you have to say, hey, we know about the sub-market that we're investing in. Here's what we know. We know how much delivery is coming. We know how many units are being absorbed. And this is still an area that has, X% population growth, but you can't just slap a hot mega, MSA buzzword and the buzzword of multifamily and expect a deal to get funded today. It's just not the way. We're going to get a bit more fundamental with our research, and we're going to say, let's talk about this business plan. Let's defend this business plan, and let's use really recent comps for what's going on. Multifamily still has a ton of tailwind. It still has a ton of great things going for it, but not every deal is going to be looked at favorably. And there are deals and submarkets that have arguably become overheated. And there's going to be some question marks that you're going to have to answer if you're in one of those areas.
Now, when you get a capital advisor, does that guy stay with you through your period of time with StackSource? Meaning, like, okay, we did this deal, I got another deal. Do I work with the same capital advisor, or is that how it works?
Yeah, absolutely. We see a lot of real estate investor clients that are working with the same capital advisor because they've built some rapport, they have built a relationship there. Because the next deal you have, even if they're both multifamily in the same range, in the same state, the capital markets are shifting quickly. And having another conversation with the same capital advisor that knows your business plan, knows your background, it's just the best way to save time and say, okay, you tell me what's different on this next business plan. I'll tell you what's shifted in the capital markets in the last 4 months. And we have some new pref equity investors that are really hot on that type of asset. And working with the same capital advisor is a great opportunity if you've done well and worked well together. So we see a lot of real estate investor clients working with the same capital advisor time and again.
That's very cool. All right, last question. And I've come this far with you, Tim. I haven't even raised the $1 million question, which is, what's going on with interest rates?
Yeah. So we have investors and lenders, truthfully, like hanging on every word of the Federal Reserve as they have these meetings several times per year. It's not quite every month. It almost feels like they're meeting every month because it seems every month everybody's looking at the Fed minutes. And so the Fed controls overnight lending rates, so the shortest term lending rates you can. They don't control treasuries. That's a product of supply and demand, but they really influence them, right? And treasuries are the best indicator of the 5, 7, 10-year commercial mortgage rates, but they influence them. And how good is the Fed feeling about the economy? The Fed does something called their dot plot, where each of the Fed officials that are in these meetings debating, do we raise the short-term interest rates? Do we lower them? Do we keep them the same? They're kind of projecting a few months and then a year out. Do we think interest rates are the consensus of that dot plot? When we look at it, there may yet be one more Federal Reserve bump in interest rates. We're kind of not seeing some of these Fed chairs bet that there's going to be more than that right now. Now, that's not a hard prediction. It's not, past indications are not always a perfect predictor because they're looking at economic data that's going to come out. But there may still yet be one more short-term interest rate hike, or it's going to stay the same. And there's also language around higher for longer. We had investors and clients say, well, we're going to wait until closer to the end of the year in 2023. And we're almost at the end of the year here, and rates do not look like they're coming back down on a short-term basis for the remainder of 2023. We'll probably see a hold in short-term rates or even one more bump in short-term rates in the next 6 months. Now, beyond 6 months, it gets really hard to predict, but we're not betting on the fact that short-term or medium-term rates of these 5, 7, 10 are going to come down in the next 6 months. That's a bad bet. If you have a deal that you're trying to put under contract, betting that the interest rates will go down before you have, that's not a good move. We're not advising people that, hey, if your deal pencils with the Fed dropping their rates or treasuries coming back down, that's a very dangerous place to be. You should be stress testing that your deal still works if rates go a bit higher.
Exactly.
And if it does, you're in a safe place rather than, hey, I'm right skirting the edge. Today's rates might get it done, or maybe I can raise some extra equity. Stress test it, put it a little bit higher, half a point higher. If it still works, move forward with your deal.
And the problem is some of these deals that were done recently were based upon rents continuing to go up nonstop, and now they're failing. And then if they had a floating rate, then that investor's screwed, absolutely screwed. So yeah, I mean, you don't have anything to do with the troubled asset lists, do you? Do you? I mean, your business is more on the front side, right?
Well, I'll tell you what, if you own a property where an interest rate cap or a loan is coming due, you need to look at, you come down to this question of, do I refinance or sell? Now, what you don't want is you're defaulting and sending it back to the lender and your equity's gone, and now that lender is trying to figure out what to do with it. If you're the principal owner here, let's say it was a simple structure a couple of years ago, you took out a bridge loan, you took out a big bridge loan, took out an 80% LTC, and there were lenders offering 2 years ago, and certainly not today, but 80% of value and 100% of rehab costs. What if you didn't get your rent increases? As you're saying, if you're sitting on something that's coming due, whether it's a cap or whether it's the loan, there are options of what to do. There are options to renegotiate with your current lender and try to extend. But ultimately, if you can't extend with your current lender, or if you can't work with a workout specialist and try to do that, you're coming down to refi versus sell. You may have a cash in refi. You may be able to convince some investors to go cash in with you if there's still enough value there, and to get a pref equity investor. So we're certainly working with some clients on, hey, what are my refinancing or maybe recapitalization options? Because I can't take a senior loan refi, but maybe I can get a new senior and a new pref equity investor because there's still a business plan that can be executed here. There's still some rents that can be achieved, or there's something else I can do with this property to boost the value, but it's going to take some time. It's going to take some capital. There are recapitalization options that we're certainly, there's some interesting things happening in that space. There are senior lenders so willing to avoid a default. They don't want to take over the property that they may allow a mezz loan to come and be originated on top of theirs, or they may allow commercial property assessed clean energy financing to come into the stack retroactively if you've already done some energy improvement upgrades. There are some interesting recapitalization options out there. Some of them take speaking to the senior lender to allow subordinate debt in the stack. You cannot put subordinate debt in the stack without the senior lender's permission. You'll do something like called an intercreditor agreement if it's mezz or if it's commercial property clean energy. Our capital advisors are having those conversations on recapitalization options if it is a distressed property, but we do need to be talking to the principal owner of that property. If you've got equity partners, you're going to have to come to an agreement. It's an interesting time, but there are options if there's value or value to be added on a property.
Okay, now let's talk turkey here. I've been through this before. You talk about senior debt, and maybe they'll be willing to, make some changes, bring in some mezz debt behind it. We are not talking about CMBS lenders, right? These would be non-CMBS people, correct?
Yeah. So CMBS is a tough one to negotiate some sort of like mezz or CB. It's honestly, it can be hard if you're a small CMBS borrower in a pooled loan, which is what most of CMBS is. They pool these loans together and slice them up as much. It can even be hard to get someone on the phone to talk to you about a renegotiation. That would be very difficult. You may be in a situation where you're forced to consider a sale of the property, whether or not you like the current value. However, another syndicated loan would be Fannie Mae or Freddie Mac on the multifamily side. They are a bit more manageable when it comes to introducing another capital source in that stack. So perhaps a pref equity. That is possible if you have an agency loan in good standing, or if you have certainly like a bridge to agency loan that hasn't been taken out to Fannie Freddie yet. They're a bit more reasonable in these conversations because their mandate is to support, housing for the country, right? And so always good to have like a green story for a Fannie Freddie. Always good to have an affordable story for a Fannie Freddie. And you can find them even more flexible and willing to have that sort of capital negotiation if you have something green, if you have something affordable, if you're providing housing in an area that needs housing. Those agencies are much more understandable than maybe your typical CMBS lender.
That's very cool. All right, Tim, we still get a hold of you at stacksource.com, right?
Yes, and Tim at stacksource.com if somebody would like to reach out directly.
And who are your best customers?
Multifamily has been a big part of our business, and so multifamily syndicators are some of our closest clients, but we also have some lower middle market commercial real estate, private equity funds that are buying shopping centers or, doing medical office. So we have all sorts of real estate investor clients that, listen, if you're bringing the right buildings to your communities and you care about those communities just as much as you care about making money, and that is the best of us in this industry. They're trying to bring some housing. You're trying to house people. You're trying to give people a place to work. Real estate investors are doing good for our communities. And if you care about the people and the buildings as much as you care about the money, we'd love to help you.
That is our motto, the Hotel to Apartment Conversion Summit, is doing well by doing good. And that is, that's what we're doing. We're trying to bring affordable housing to those places through just recycled properties. And the numbers just work. The numbers just work. And Tim, I'm going to show you how well the numbers work. I'm going to put my next deal on stacksource.com.
Love it. And I'd love to have a conversation between you and a capital advisor about that, Charles. And I love that you're bringing housing to places that need it.
That's awesome. All right, buddy. Good to see you again. So happy that you're down there with your family and down there in Florida. Good for you. You're living the life. And you and I will be talking very soon.
Excellent. Have a great day.
Thanks, man. You too.